There are countless patterns traders rely on, but in this video, we are going to focus on the one that consistently proved to be the most effective and frequent. So let's get started with the first pattern on the list, the double top and double bottom. We'll start with the double top. Imagine the price is in an uptrend, moving higher. At some point, it reaches a certain eye twice. These two peaks form what we call a resistance level, and the low point between them creates what's known as a neckline. From a price action perspective, what does this double top tell us? Essentially, it indicates that the price tried to move higher but couldn't break past the previous high. This signals a loss of momentum from the buyers, suggesting the uptrend is weakening. On the flip side, we have the double bottom. Here, the price is in a downtrend moving lower. Then it hits the same low, twice forming a support level with the swing high, between them creating the neckline. What does a double bottom reveal? It shows that the price failed to make a lower low, indicating that sellers are losing strength and the downtrend is losing momentum. Now that we understand these patterns, the important question is, how do we incorporate the double bottom and the double top in our trading strategy? We'll begin with the first one, the neckline break entry. Let's start by looking at the double top pattern. You'll notice that after the two highs are formed, a neckline is drawn based on a recent swing low. The key moment comes when the price breaks below that neckline and makes a lower low. This confirmed the trend reversal. And at this point, you'd enter a short position as the market is signaling a shift from bullish to bearish. Now, flipping this to the double bottom pattern. The neckline forms based on the recent swing high. Once the price breaks above the neckline and makes a higher high, the trend reversal is confirmed, signaling an opportunity to take a long entry. This indicates that the market is transitioning from bearish to bullish. Next, let's explore the second variation, which involves identifying a double top or double bottom at a key level. You need to identify the key level, which can be done by spotting reversal points. As the price comes back down, it forms a double bottom pattern right at this key support level. To confirm the reversal, you place the neckline at the recent swing high. Once the price breaks through that neckline and makes a higher high, the trend changes from a downtrend to an uptrend, and you can enter a long position typically on a lower time frame. Another confirmation method you can use involves drawing a trend line connecting the two swing highs. Once the price breaks through this trend line, you have an additional signals to enter a long trade. So, what does trading a double top or double bottom at a key level tell you about the price action? It offers a high-quality entry because you're not only trading the pattern itself, but you're also factoring a key level of support or resistance. This attracts both support and resistance traders and pattern traders, increasing the momentum behind the trade and ultimately improving trade quality. Now let's move on to the third variation. Instead of taking the breakout entry immediately, you could wait for the price to pull back to the newly established support level. This second entry on the pullback often provides a better and more secure opportunity. What makes this level particularly attractive is that it was formed earlier, making it a strong point of reference.